Hey, everybody. Welcome to the podcast. Happy Friday to you. Hopefully you get to watch this podcast on your way out the door. Hopefully you have a good weekend. And as you can see, the stock market really green today. Pretty much everything on the screen green except for, obviously, volatility was the only down thing today. And I'm not going to even go through each one because they were all up pretty much over 2%. Actually, Dow was the laggard. And in a typical market, that's what you expect is tech and small caps to kind of lead the way. We had financial strong today and utilities lagging a bit. And again, that's what the bulls would hope for, is that a broad-based market, strong volume, all of that stuff, and then in the order, having the riskier stuff lead the way and the safer stuff kind of lagging behind but still green on the day. And that's what we got. All right, well, I'm going to try to keep this short, and I seem to have said that the last few podcasts, and then I keep blabbering, and on we go. But I'll keep it short. We have a lot to cover, but I think it's actually pretty simple what's going on. That doesn't make it easy to invest, and I've talked to a lot of you lately that are either frustrated because you're saying this feels toppy, or you're saying I'm not invested enough, or I don't trust it. There's all these reasons why a lot of people, frankly, are just out of the market right now, or very, very light in stocks. And but it's pretty easy what's going on. What's going on is the fact that, and this goes back to what I've discussed several podcasts in a row, is that shorts and bears are afraid to be short, or short more, whatever the case may be, because of the fact that what's happened this week is exactly what the potential was for a huge rally, which is you have some bad economic news, right? We had 1.5% second quarter GDP today, not the greatest of reports, and yet the market rallies. Why? Because more bad news lends itself to more intervention by central bankers. And I know you're listening going, wait, I thought that was a bad thing. It is a bad thing. But remember, the stock market, short-term traders, they don't care about the financial future of the U.S. or the world. What they care about is, what is the next 48 hours going to look like? Is Spain going to collapse tomorrow? What is the economy going to look like 2 or 3 months from now? That's what they care about. They don't care about the long-term future of our country, and which is sad because obviously we all should. But the problem is that they're addicted, like a drug addict, to this artificial stimulus by central bankers. And the main thing that I have been worried about being not having enough stocks, is the fact that you would have a concerted effort. Now, what we saw this week, coincidental or not, who knows, but it started with the stock market falling, and you can see here over on the right side of the screen, we had 3 or 4 down days in a row, and then lo and behold, the market rallied back one of those days and got back about half of its gains. It was down about 240, and I think it finished down about 110 or so. The reason it did that was there was an article in the Wall Street Journal that the Fed would stand ready to do whatever is necessary. No news there, but it perhaps makes the date at which they do quantitative easing 3 pushed up a little bit. So the market rallies. Okay, rumor, right? That's a rumor. That is more intervention, more stimulus. Market likes that. Then Mario Draghi, ECB president, kind of the equivalent of Ben Bernanke in Europe, says basically the same thing. Hey, we stand ready. I'm going to take over if I need to, and do some big, powerful things that will fix everything with a magic wand. And the stock market goes up 200 points yesterday, but we didn't see a real strong day as far as upside volume. So yesterday, while good, was okay, but it was kind of stuck at this 100-day moving average. Then you come in this morning, bad economic report, stock market opens mediocre, kind of flat, and then it just gets stronger as the day goes on. And as it continued to go up, more and more rumors came out. And so, again, if you're somebody that's bearish or short the market, this was your biggest fear, is a concerted effort to say, hey, we're all going to be ready to do what we need to do, and the shorts run for cover. Now, what this means is QE3 is being priced into the markets as we speak. It is being priced in, which means if it does happen, or should I say when it happens, you should worry about the stock market potentially selling off. Buy the rumor, sell the news. That's what this appears to be to me. But when we look at this, and again, my job is always to be agnostic about the situation. I've got my personal feelings about what they should be doing, all those things, but I want to take this and objectively look at it and say, hey, how can we make money in a safe way? That's what I want to do. And what we're seeing today is the stock market is kind of broken out from this little downtrend that it was in, going all the way back to the peak in early April. Now, yeah, you could move this line and say, well, the top of this day here on May 1st was 14.15, so that's really where the line should be drawn. So we haven't quite broken out just yet. Regardless, it's what it's really continuing to do, and I'm going to draw another line for you because I know you love seeing lines on the screen, is we're still kind of going up in this little channel here, and however you want to draw these lines. So, could we get to 1400? We could get to 1400, roll back down, come on back down to 1350, but we are making higher lows. There's no question about it. But again, the key is why is it happening? And it's happening because of quantitative easing likelihood going up. And the thing is, as I've stated for several months, I thought it was going to happen. But the data was getting so bad, it's hard to be very bullish and really want to be heavily invested in stocks when the data continues to get worse. So you're caught between a rock and a hard place, right? You're caught between, I need to be safe because I know that things are getting worse around the world, not better. But on the other hand, I want to make money. And so what do? Well, what I've been doing is splitting the difference. And yes, on a day like today, I wish I was, I'd leverage my house to buy more. However, I made money today. And I have a lot of things that went up. Well, pretty much almost everything went up. But I'm a little bit further down on the risk scale. So as opposed to owning a bunch of emerging markets and opposed to owning, the Spain ETF, I'm coming down the ladder a little bit, owning REITs and utilities and maybe some, good growth stocks and things like that, and maybe some energy names. That's okay. I own that stuff. So still happy on a day like today. But again, why it's happening is pretty easy to understand why it's going up. The layperson's going to look at this weekend and say, looks like our economy's getting worse. Why is it going up? Well, you and I know, and most of Wall Street knows, it's because of quantitative easing and the high likelihood of that. But that doesn't mean it's easy to invest in. So I would say, look, we're in a picture right now, and I did a blog on this yesterday. This is the time frame I think you need to be looking at, which is an hourly time frame. And you can see, based on this hourly time frame, let me take off a couple of these lines here. In fact, let me do this. On an hourly time frame, you're going to see that the stock market is in this trend, and we're getting close to the top of it right now. So if you're somebody that's watching this and wants to trade over a 3, 4, 5 day period, you're getting to the top of this range, which means it's probably going to roll over and come back down. If it comes down and doesn't go all the way down to the bottom, let's say it goes down to 1360 and then turns right back around, heads back up, and we get more participation like we got today, that's fine. But again, there's nothing showing me that we're breaking out of this range necessarily. I think we're gyrating around, and my long-term thesis is still that the stock market is in a process of rolling over. Now, one other thing to consider is that many of you, when I talk to you on the phone or through emails, express a lot of concern. You express concern about the election coming up, and you express concern about the debt in this country and what the Federal Reserve is doing. Those are all legitimate concerns that I share. But because you feel that way, and probably millions of people around the country feel the same way, what ends up happening is that those means if you feel that way, you're not 100% invested. So what we're seeing is the people through surveys that are bullish is at a very, very low level right now. And it's at the lowest level since March of 2009. Now, you may look at that and say, well, if it's so low all the way back to March of 2009, wasn't March of 2009 the beginning of this 3-year bull market? Yes. However, there was a period in 2007 where people were just as bearish as they are today, and it was near the top. In other words, in 2007, we rolled over, the stock market went down just a little bit, people got bearish, it rallied for a few days like it did today and yesterday, and then eventually it rolled over, and we ended up having a horrible bear market. So most of the time, this is a good indicator that, hey, people are too bearish, and you need to take the other side and be a contrarian. But I just want to point out that there was a time, not that long ago in 2007, where people were bearish, And yes, you got a temporary rally, but that was the right thing to do would be bearish because things got a lot worse. So again, there's not one perfect indicator, but I'm pointing out that there is a pattern sometimes, but you have to look at several indicators in conjunction, because if you just rely on, hey, this one says to fade it or this one says to go with it, you're going to get burned that one time. So I'm still, again, playing things in the middle, making some money. Obviously not going up as fast as the market in the last couple of days here, but look, when the market goes down like it did from the screen here, you can see, July 19th through the 24th, I sleep at night, and that's fine. So we're going to get a crack one where we're either things start improving and the market starts, maybe the market is going up right now because it's sensing that the economy is just about to turn around. And I know that's not what I'm seeing either, but you know what? Could be. We need to be prepared for that just as much as we need to be prepared for the downside. But you are seeing some of these leading indicators. ECRIs come out with some of their stuff has actually popped up in the last few days or last few weeks. Is that just a temporary pop? You know, you talk about a soft patch in the economy. Is this just a strong patch in certain areas? Maybe. And so the stock market's reacting. But again, it's a difficult environment. I'm keeping the income high. Take profits when everybody thinks everything's okay. And then perhaps when you get down to the bottom end of these ranges, go ahead and add a little bit. That's what I'm trying to do here through this tough time. But it's difficult when you see something like Spain go up 6% in their stock market, and then the next day it's down 6%. Still not an easy environment. Don't let anybody fool you. Things are not getting better. They're simply, either getting worse or very best in the U.S. stagnant at 1.5%. All right, guys, don't forget KarlEggers.com. I've also started posting my stuff on Facebook. I know I told you I never would, but I decided to do it. So it's on there. So I'm on Facebook, I guess. Anyways, look me up on there, and Google+, Twitter.com/KarlEggers, all those places. Have a wonderful weekend, and we'll talk to you soon.